And good day, everybody. I am Michael Filighera. I am with tradershelpingtraders.com and logicalsignals.com. And today I am joined again by a colleague and a great friend, Dan Ascani, who is with defendingyourmoney.com. And we are here to do the Eye of the Storm podcast. And today we are going to be doing a behind the curtain view. We're going to be taking a look behind the curtain against everything that's been happening. And today's date is June the 17th, 2023. So welcome, Dan. Thank you so much for coming
Thanks
back.
for having
We've
me
been
back.
talking about it, and then finally we're like, okay, we got it. We're doing it. And it is really important. And I'm just going to kind of lay out some of the format that we want to use today, because as most everybody knows, that it has been declared official that the markets, I don't know if they're just saying the market or the markets, are in a new bull market because they have off of the October lows, at least one has moved 20% off of the lows and up. And so they're declaring a new bull market. Dan and I both, and excuse me, as I work through my period of hoarseness in my voice, Dan and I have also been do Elliott Wave. And those that follow me have realized that I continue to count all of the current activity that we're seeing in the Dow, in the S&P, and in the Russell, and also in the NASDAQ as a primary B wave. And that primary A wave bottom was in October of 2022. So for the last 9 months, we have been tracking a primary B wave. And Dan and I, all through this, have had numerous discussions. And now our discussion is broadened. And we want to bring that to you guys because there's been so many things that do go along with the market rallying. And we are feeling that, yep, the market is rallying, no doubt. But we want to fill in some of the blanks or just take a look behind the curtain to not necessarily dispel anything, but just to add to the conversation so that we're all able to make solid decisions about what we're doing and how we want to do it. So we're going to take a step behind the curtain. And the first thing we're going to talk about is the fact that, yes, the equity markets have rallied. And there's a lot of, and this is a lot of what we want to call frothiness in the markets and developing. And so I'm going to just kind of turn these particular topics over to Dan because he has a great deal of wonderful information to share with us. And I know you all get it from me because if you listen to my daily podcast and so you're already getting that. So now I'm going to turn this over to Dan. And so we're going to go with the equity market rally.
You don't want me to do all the talking, do you?
I think I'll be adding some here and there.
Thank you.
But I have found that the data and the points that you're going to be making are, I think, extremely important. So I think I'm going to allow most of our discussion.
Well, first, to address what you were saying, somewhere several years ago, I think some financial media outlet decided that a bull market should be defined by a 20% rally or 20% advance. So when an index or the market or whatever it is we're looking at has rallied 20% off of presumably a bear market low, they declare that means it's in a bull market, which I staunchly disagree with for a couple of reasons. One, we'll show a couple of reasons right now, but one, why 20%? It's like kind of an arbitrary number. Why not 24% or 18.5? Where did the 20 come from? And secondly, if you wait till the market's rallied 20% to declare a bull market, you just missed 20%, right? So then you're going to act. I don't know what that means. And thirdly, which index are we talking about? Because if you look at the S&P 500, it's rallied 20%. NASDAQ is way over 20% off the October low. The Russell 2000, as we'll show in a minute, is not. So does that mean we have a bull market in all stocks, or is it only in some stocks and the Russell 2000 is not in one? And what kind of a bull market would that be if only some indices are in a bull market and others aren't? So I don't know. I mean, through my history, I don't know a bull market without all the indices participating. I've never seen one like the Russell 2000 lagging. Seriously, the Russell 2000 is an index of smaller cap stocks, publicly traded stocks. It's only up 13%.
Right. And if I may just interject, that your experience now, we're not just talking about 20 years experience or going back to, the 1990s, folks. We're going back to the 80s and before. Both Dan and I have been trading and following markets. I think we did talk one time, Dan, and we're over 80 years combined experience. I know. We don't
Okay,
look
you're
that
right.
old.
I'm old. I got it. I'm
We
old.
don't look that old, but our combined experience is vast and it's very deep. And so just please understand, it's not that we have not witnessed bull markets, bear markets, and everything in between.
And that's a good point, because if you go back to the 70s, that was a true period of a bear market, or at best sideways. I mean, there was some movement, but basically from 1968 to 1982, the market went net sideways. But in real terms, it lost 70% of its value. That means adjusted for inflation during that inflationary period, you lost 70%, even though the Dow may have ended up in the same spot roughly about whatever it was, 14 to 16 years later.
Yeah.
That was a bear market. There were also 2000 to 2002 .com bubble burst. NASDAQ lost something like close to 90% of its value.
Yes.
Then there was the bear market, 17 months from October 2007 to March 2009, and that involved the crash. That was a 17-month punishing period. And, that was a bear market, but it involved a crash. This one is acting more like the one in the 70s, and not coincidentally, we had inflation then. In fact, this is the most inflation we've experienced since that time. So there's something about inflation and the Fed tightening, and Jay Powell, the Fed chairman, trying to emulate Paul Volcker, the Fed chairman back then, who broke the back of inflation, or at least he gets credit for it.
Yeah.
So it's similarities there. But back to our point, because I want to get on to some other things about the equity market, and I'm going to try to share a screen here, but back to our point, if you look at, for example, the NASDAQ, see if I can bring that up here. For those who are listening through audio and not seeing a screen, I'm just bringing a chart of the NASDAQ 100 up just to show the end of the bull market this was late 2021, actually. Then we had the bear market decline into October 2022. And now we've seen the NASDAQ go up kind of a lot. It's retraced over a Fibonacci 618 of the decline. And it's a little bit past that now. Some stocks like Microsoft and Apple are at a record high or close to it. So this index has gone up because it's tech heavy, and technology is usually what brings economies out of recession or out of difficult periods. It's usually tech that responds first, and we're seeing that now. Plus the huge advances in AI, artificial intelligence. Perfect example of a technology that's going to bring us out of the doldrums at some point. But my point here is not that, but that we've got the NASDAQ here. You jump over to the S&P 500. Got a bunch of other stuff on this chart, but similar thing, not quite as much of a rally, but still a rally. And that's a little bit over 20% now, up from the October low in the S&P 500. But if you look at the Russell 2000, and that's what you and I were talking about, that's an index of 2,000 smaller capitalization stocks. Here's the bear market decline, and it's a sideways pattern, a bear flag. I've got some Elliott wave labels on there. We talk about a lot more than Elliott wave, but whether you're into Elliott waves or not, this, for technical analysts, is a bear flag. It's a sideways pattern lasting it's closing in on a year now of going sideways. And that's not typically a bull market. I mean, if this just suddenly lights up and goes to a record high, then I guess maybe it is. But I've always known the Russell 2000 to be to lead the way up. That contradicts what I just said about technology, but I'm not saying that technology doesn't lead us out of economic doldrums, but I am saying that the Russell, I've never known the market to advance in a solid bull market without the Russell 2000, and it's seriously lagging here. One reason for that is because of the fundamentals going on. There are probably more reasons why the market's not in a bull market. So these are smaller cap stocks,
Right.
smaller publicly traded stocks. A lot of them are dependent on financing, and a lot of them have variable rate terms. So their cost of doing business is constantly rising as long as the Fed is tightening, as long as the Fed is raising rates. And that's keeping the Russell 2000 from being able to perform.
Right.
Instead of a big move up, it's actually in that sideways bear pattern. And I mentioned interest rates, and I want to talk about that again because the Fed this past week, the June FOMC meeting on interest rates, gave a hawkish pause, meaning it didn't raise rates finally for the first time in 15 months. But Jay Powell, the chairman's comments were hawkish, meaning there's a couple more rate increases likely to come. The Fed's not done tightening yet. So it would be unusual for a big bull market to start before the Fed is done tightening. There's other things to throw in there too. The yield curve is seriously inverted right now, badly inverted. That means that short-term interest rates, like let's say it's inverted at several levels, but let's say the 2-year Treasury note minus the 10-year. The 2-year Treasury note is way higher than the 10-year. Mm-hmm. Same with the 3-month T-bill, way higher than the 30-year bond even. Mm-hmm. So short-term rates are still really high. That's a symptom that the economy is trying to slow. The Fed is tight. Again, it would be an unusual time for the market to launch a huge bull market, especially when you see small caps lagging. That's another thing. 18 months since the Fed started quantitative tightening, term that can be applied to the Fed's not only raising rates to slow the economy and get inflation under control, but it's trying to bleed off its balance sheet. So after the 2008 crash, great financial crisis, they call it now, the Fed was buying securities, buying municipal bonds, treasury bonds, mortgage-backed securities, and putting them on its own balance sheet, trying to support the market and provide it with liquidity.
Right.
When the Fed buys bonds, it pays for them, and that injects liquidity into the system, and the Fed takes the bond as an asset and keeps it. So the Fed ran up trillions of dollars on its balance sheet, buying up all these securities for a quantitative easing period of 13 to 14 years or so since the 2008 crash, until it finally started to tighten about 15 months ago. Now it's starting to slowly drain off those assets. And the time lag of Fed tightening from when they started until the economy finally slows, and when the yield curve inverted till when the economy slows, it's typically 18 months, and we're just about there right now, just about almost there. So we're seeing a slowing in the economy, which has been strong, and a lot of people say the economy is resilient, and it is, but a time lag hasn't hit yet, which is why I was glad to see the Fed take a pause. Let's let what you've done, the rapid increase in interest rates and your attempt at quantitative tightening, let's let that hit for a while, filter through the economy, because it is slowing things down, and the Fed's now warning about commercial real estate. It's watching it because, again, variable rate loans is higher vacancy rates in office buildings for various reasons. So we've got a lot of reasons to think that this whole problem of inflation, rising rates, tightening Fed, even the banking system stresses that we've seen, a lot of reasons to say that kind of stuff isn't over yet. And I know the market's forward looking, so I'm always one for saying the market's not investing. People aren't investing for today's headlines, although the headlines do affect people's decision making. But people are investing for 6 to 9 to 12 months out. So allowing that cycle to tighten, allowing the Fed to the Fed's quantitative tightening to take effect, it's probably a wiser thing to do than declare a bull market right now. And by the way, you can interject if you want, Michael. I'm just kind of talking here.
I'm enjoying the conversation. Because I stand in agreement with you. The one thing that I will add is that again, folks, those of you who don't know, I live in San Francisco in California, and San Francisco has been hit extremely hard from the pandemic, and the fact that prior to the pandemic actually taking hold, the construction boom was in full swing, and we were in full swing in building office towers and apartment complexes and condo complexes. And then suddenly we get the pandemic and everybody is forced to stay home. We went through a shutdown, and much of the tech growth in San Francisco pulled back, of course. And for example, Meta or Facebook, prior to the pandemic, had rented two incomplete, so they were under construction, but two full buildings in downtown San Francisco that totaled well over 400,000 square feet of office space, of which still is empty. Salesforce had put in and built out or looked for and got commitments on, I think, like 203 or 240, somewhere in there, 1,000 square feet, which they're not able to take. Microsoft, Google, Pinterest, on and on and on. Uber left their building that they had on one section of the city and went down to next to where the Warriors play in this Chase Center, as it's being called, and actually rented most of that building, which they're now looking to sublease. So this whole concept, and I'm just talking San Francisco, let alone Los Angeles or San Diego in California, or Portland, Oregon, Seattle, Washington, Chicago, New York, Boston, our Philadelphia, our major, our major cities that are the not just tech centers, but they're the business centers, particularly New York. Now, New York is not suffering as much, but they are having a little bit of a vacancy problem. And right now, as it stands, here in San Francisco, the vacancy, the commercial real estate vacancy, is over 31%. And it's not stopping. In fact, Dan and I were discussing, it's like we have several of the larger hotels. One group has the Park Central, but also they own the Hilton, or the building that the Hilton is in, the hotel. They've walked away. They've walked away from the building. They've turned them back over to the lenders instead of having to pay or address how they're going to deal with $725 million loan. Then we have the Westfield Mall, which is basically downtown, but it was bustling. It was major, and it was always packed, full of tourists, full of just people. There was a great shopping center. The owners of Westfield Mall have walked away from that debt and turned it over to the lenders. We have all of this empty office space. So I'm kind of keeping an eye and an ear out for when those developers are going to walk away and turn it back to the financiers. And we've already had one building that was supposed to be a 60-story building that they had started construction, halted. Now it's a big hole in the ground. Part of it's done and it's gone. And the firm that was going to, it's a Chinese firm that actually had won the award to construct the building. They've walked away because
So
go ahead.
Imagine if the Fed isn't done, and these commercial concerns, these commercial real estate concerns, have variable rate loans that they have to pay.
Right.
Imagine if the Fed's not done and we're seeing the stresses you're talking about now, but there's more interest rate hikes to come. It's just going to keep squeezing and squeezing
everybody.
And people might be saying, well, so why is the stock market rallying then? I mean, why is the market ignoring that? First of all, good question. I mean, I talk to a lot of institutions and professionals. They're like, people's jaws are hanging open. Like, how is the market ignoring not just the kind of stuff you and I are talking about, but the fact that the bond market is reflecting in the interest rate markets are so high. Interest rate markets seem to be saying there's going to be a recession. At least the long bond does. Long bond being the 30-year bond, much lower interest rate than the shorter term treasuries. Kind of saying, oh, maybe there's going to be a recession. And if there's a recession, that means what you and I are talking about is going to get worse.
It's going to get worse.
And the stock market's in a counter trend rally. You mentioned primary B wave rally. For those who don't know, Elliott wave, a B wave rally is a counter trend rally. So that would presume that the bear market that began in 2021 in some cases, and the first business day of 2022 in the S&P 500 isn't over. Mm-hmm. And other people might say it doesn't matter what you call it, bull or bear, who cares? Well, that may be true, but what you and I are talking about is the media buzz declaring this a bull market, and I think that's misleading. Not that the media is purposely doing that, but someone has decided years ago to define a bull market as a 20% rise.
Right.
And we're not seeing that in the Russell 2000, which is
no. In fact,
it's
interesting, and maybe just to highlight that, it's forming a triangle, folks. It's a wedge. And the pattern that's actually enforced is showing that it's the E wave, which is the final leg of it, is heading up towards the top side of that wedge. So what comes out of that, and again, if you've studied Elliott, the response, of course, is that once the triangle's finished, it thrusts out of the triangle. In this case, the direction would be down. It's thrust down. Now, most of the time, say, well, what's going to cause that? And it's like I get asked often because I'm thinking, right after a primary B wave, counter trend, it drops back into trend via a C wave, which is going to be very damaging in the other markets. And here, it's still going to be a C wave, but it's not starting at the same levels as the others. So I think the damage that could come to the Russell as it thrusts out, and if you notice that arrow that Dan has a very nicely drawn, that's going to be the severity of that C wave. Now, it's not that Dan and I are perma bears. It's not that we're always constantly looking for a top. Please understand that both of us we're just monitoring and watching the market at the progression of the wave pattern that's in place right now. I'm not necessarily saying that I'm a perma bear. I'm not. But this is what we see. This is the pattern that we both have spent years upon years upon years of studying and following and tracking previously. So
besides, I can't be a perma bear. I've put out research for decades, a lot of it for years worth of a bull market, and I've managed money. So I'm
right.
Can't be a perma bear. I've been a bull before, and by the same logic, somebody could have accused me of being a perma bull, which I wasn't. I just like to call them as I see them.
Right.
And, whether you can see the chart that I have on the screen or not, you're listening to the audio. What I've got is the first leg of the bear market into last year, the sideways bear flag we're in now, and then the arrow pointing downward, which is the implied move to come once this rally phase is over. So I'd actually like to take a look for a second at why the market's rallying, because
yes,
people might be saying, then why is the market rallying? That's an excellent question. And you got to go with it. You can't be saying, well, I think the market's going to drop and it's not a bull market, so I'm going to sit here and keep shorting it all the way up, or I'm not going to buy it. That's not what I mean.
Exactly. And that's not what we do either.
Exactly.
Okay.
Most
yes,
people are.
This is great information you're about to tell us.
Right. So the market loves and seeks liquidity. That's why it hangs on every word the Fed says.
Yes.
And when the Fed's not saying something, you can't wait till the next time the Fed speaks, or a Fed governor speaks, or there's an interest rate meeting, so the market can find out when it's going to get more liquidity pumped in. Because the fundamentals you and I are talking about, rising interest rate, inverted yield curve, increasing vacancy space in office buildings and malls, and especially in San Francisco and Manhattan and wherever else it's catching on like that. Those are not the fundamentals of a bull market. So if we try to look at, I'm trying to find this next chart, if I could bring it up here. I'm not really finding it here. Hold on a sec. But the market seeks liquidity. And that's why the Fed's quantitative easing policy that began with the 2008 crash of the Fed constantly buying bonds, buying mortgage backs, and just propping things up, pumping liquidity in. That's what got the market going for so long. It was a liquidity driven advance. And yes, the economy expanded during that time, but not to the extent of the multiples we saw. That's why we dropped into a bear market. But if you look at right now, I'm sure I can find this chart on the share screen tool here, but what I've got here nonetheless is a chart of the Fed balance sheet, which you can get from the Federal Reserve, the FRED site, FRED, that's the Federal Reserve Economic Data site put out by the St. Louis Fed. If you just bring up total assets, the Wednesday levels, it shows the huge expansion of the Fed's balance sheet for years, followed by a decline that's going on now. So the Fed is draining liquidity if you look at the balance sheet. But if we look at something else here, because what I just said, the Fed draining the balance sheet would imply that the market shouldn't be rallying based on liquidity. What's really happening is we had a little banking crisis in March where Silicon Valley Bank failed, a couple others failed, and the stresses on the banking system are illuminated. So what that resulted in was the Fed having to inject liquidity into the system. I've heard it's to the tune of $440 billion of liquidity starting in around March.
Yeah.
And so if you look at the net effect of the Fed's quantitative tightening attempt, that's why I called it an attempt at quantitative tightening. The net effect is we actually got an injection of liquidity this year. So the Fed really hasn't gotten serious about quantitative tightening yet, even though it sounds like it's serious. You listen to Jay Powell, he sounds serious.
He sure does.
Nonetheless, the bank run, some people call it a bank walk, that occurred in March, when Silicon Valley Bank failed, and we had those stresses, caused the Fed to inject liquidity in. So the market is absorbing that liquidity. Market likes liquidity. I'm talking about the equity market here, the stock market.
Yeah.
And it's run up. It's takes that liquidity and puts it into the market. And we're starting to see that liquidity start to run out. So we should be getting toward the tail end of that injection of liquidity and back to quantitative easing, quantitative tightening.
I know, so we have to be very careful with our words. Whoops, I didn't mean that. I wanted to add, and I also have a question that we just talked about the commercial loans or commercial real estate. And it's now, and you and I have been talking about this for well over a year. But I'm seeing how it's creeping back into the news now, and how now more and more, CEOs of some of the larger banks are beginning to mention it, and we're starting to see it. And we also have talked about when Silicon Valley had their problems and Key Signature had their problems and First Republic had their problems, all going into receivership, all being sold off to one or more of the too big to fail banks. But when I look at that, and I think that what really now is going to start to, I believe, happen, and as we get into 2024, it's going to start to accelerate a little bit. If we got this problem with the vacancy rates, those loan holders and then the regional banks, which have really been set up to provide these types of loans for their areas. So they finance malls, they finance buildings, they finance new apartment structures, et cetera, et cetera. That's what they do. And so the Fed kind of goes, yep, we'll be there, we'll help you, we'll do whatever we need to do. Now they're going to get themselves in trouble. So when I talk about that, what really has gone unresolved, because it really hasn't shown its thorn yet, so to speak, are the regional banks that are up to here in these commercial loans that are due to roll over and to be refinanced. And what's going to start to happen is your building is half empty. You're a risk now to go take $725 million and let's roll it into a new loan. So we've got that to consider. So my question is not necessarily about the commercial real estate, but part of the infrastructure package that did get passed and made law at the beginning of this year, that how much liquidity comes in, because part of the package was, I think the initial part, I'm not sure how many billion, but I want to say at least 2 to 400 billion dollars initial that goes out to bid to start the work. Does that then also come in the form of liquidity by the federal government, basically?
Yeah. Well, good question. I mean, that liquidity that would affect the equity market anyway would need to come from the Fed at some point, even though the Treasury Department issues treasuries. But when they issue treasuries, that's pulling liquidity out of the system because people
Right.
are paying
Right.
the treasury in exchange for a treasury bill or note, whatever. So the liquidity would have to come from the Fed, and the Fed wants to drain liquidity. It doesn't want to
Right.
keep pumping liquidity. It just kind of seemed like it had to when Silicon Valley Bank and a couple others failed. So,
But could it possibly really affect them in terms of that? We talk about that our jobs market right now is quite robust, and it's kind of like the stick in the spokes in terms of as being great that people are finding jobs and they're working and they're able to support themselves and their families, etc. I think that warms my heart. That's great versus having to go through the horror of not having enough funds available. So I'm happy about that. But I think that what the infrastructure bill being passed and now being put into effect and to work is going to be giving jobs to a lot more people, and the money is going to be provided by the government putting that into our economy. Is that going to, and not necessarily backfire, because it's a good thing because we get new roads, bridges, et cetera, which we are in desperate need of. Building out our infrastructure in several areas, it's what the country needs. But the timing may just really offset the Fed's job of trying to get, as Jay Powell says over and over again, yes, our goal is still to tackle inflation and get it back to a 2% goal. Will all of this coming in be like another stick in the spokes?
I think the creation of jobs by federal funding like that is a good thing, but I think that's also a small section of the economy. What's probably going to slow are multiple industries that haven't slowed yet.
Okay.
And, that remains to be seen. How much is the economy going to slow? But if the Fed can get back to actually draining liquidity,
Mhm.
quantitative tightening,
Mhm.
without these banking crises
Mhm.
causing them to interrupt their tightening regiment there, is that going to happen once the Fed starts really draining
So,
liquidity?
so the bigger threat really then sits over there in commercial real estate.
Well, that's one of the commercial real estate is one of the areas that feels these kinds of economic downturns, and there's so much debt out there
Yeah.
to mature and need to be refinanced by 2025, that as we get closer to 2025, this is going to come more to a head. That's why Jay Powell said, and I think I've heard Janet Yellen, the Treasury Secretary, say also, they're watching commercial real estate. And we're thinking, why are you watching commercial real estate? What are you watching? What are you worried about? They're worried about the same things you and I are talking about.
Right.
But it's interesting that at the June FOMC meeting that we just had,
Right.
Jay Powell's press conference, he mentioned that they're watching commercial real estate. So
Right.
that's something to watch. And also, we're talking about, a new bull market and all that. Typically, commercial real estate or real estate in general would have been through its entire contractionary cycle by the time we're ready to come out of a recession and
Right.
start a new bull market.
Right.
And that we're still going the other way. We're still going the wrong way in commercial real estate and so forth.
Right.
And there's still more to come if the Fed keeps tightening. So this liquidity that we're seeing that came in to the tune of something like 440 billion that the Fed put in when Silicon Valley Bank failed, along with a couple others, that's starting to run out. It's starting to run its course.
Right.
I'm looking at another chart of Fed net liquidity. It's not on the screen, but for those of you listening also, and the net liquidity is showing that we actually got about 100. I've heard it estimated, I think it was by an Oppenheimer analyst, of 100 billion in quantitative easing we got instead of tightening. And so if you look at a chart of the S&P 500 versus the Fed draining of liquidity, they were declining together until the banking crisis.
Mm-hmm.
And then we saw that Fed injection liquidity, and that's causing the S&P 500 to diverge from the overall draining of assets from the Fed's balance sheet. That's how one way that they're tightening all those mortgage backs, all those treasuries that they bought for years since the crash of '08. They're now letting them roll off their balance sheet. They're getting rid of them, and that's a tightening. In fact, it's a serious tightening, unless the Fed counteracts it with liquidity. And I think Jay Powell, he wants to, and the Fed wants to tighten maybe faster than they've been able to do because of the banking situation this year. But I say good luck with that, because the regional banks and this whole stress on the bank system is not over.
Right.
And this was caused partly by years of quantitative easing, followed by the Fed's sharp reversal in 2021 to quantitative tightening and the raising of interest rates. That caught everyone by, I don't want to say surprise, because the Fed broadcast it, caught them all flat-footed.
Right.
Because everyone was positioned, especially after the COVID crash and that injection of Fed liquidity. The banks were positioned with treasuries that they bought as their investment portfolio at low interest rates. So when interest rates rise, the value of bonds go the opposite way. They decline. And so when there was the bank run starting at Silicon Valley in March,
Mm-hmm.
Silicon Valley Bank, the run was so severe, withdrawal of deposit money was so severe that the bank had to sell those treasuries at a loss. Mm-hmm. And that caused them to go insolvent and then have to go into receivership by the FDIC. And that kind of tension is not over yet. This is more of a slow series of earthquakes in the banking system.
Right.
Hopefully it doesn't end in a cascading collapse like we've seen a couple of times, '08 and then the 1980s. When 500 or so savings and loans went
down.
Slowly, through the Resolution Trust Corporation, absorbed those and then dealt with the problem. Hopefully this one's slow enough to be able to deal with. But in any case, we still have that to consider. And those stresses are, a little bit worrisome. I'm not saying everyone should sit here and worry about everything, but, you and I are talking about reasons why this probably is not the start of a bull market.
Right.
That means people should not let their guard down, in my opinion.
Right.
Yes, right. Take advantage of this counter trend rally.
Maybe
you already have, but don't let your guard down, because we could be in a sudden resumption of this bear market, and that got pretty nasty. That caught people last year in 2022, especially when there was the sudden invasion of Ukraine by Russia. And we have enough geopolitical tensions now to cause headline risk. Wake up to something horrible like
boom,
God forbid, but Putin has now moved nukes into Belarus.
Yeah.
And I know he's playing this cat and mouse type of game, but it's not a game to be played with nukes. Anyway, any type of desperate response from Russia off of the counteroffensive in Ukraine, or Putin's nuke game, or whatever goes on, the tensions with China, again, not to overly worry about those things, but those are risks that we could wake up suddenly and be having to deal with them again and have an upset equity market.
Right.
Again. So that's something to consider.
Yes, it is. And we're actually going to try to be very good, folks, and that we're trying to put our time wisely together. So we're going to go into summary now. And I think that what we're both saying is that, yes, the market has been rallying. We question the validity of a 20% call that it's a new bull market, and that through our work and just through our own experiences, that it usually doesn't start when we see PE ratios of 20%, 20 or higher, that's not a starting point for a bull market. When we see, such as in the Russell, where we see that it's a bear flag that's been forming off of the October lows, that's not the start of a bull market. That and even in the way of like a B wave pattern that we're seeing in the S&P, in the Dow, in the Nasdaq, that's not how a bull market begins. And so, and also just with the inflation picture and everything else put together, it's not setting the groundwork. It's not setting a solid foundation for which a market will build an extended run higher, with the economy operating on all cylinders and everything's going, not where we're being told that we should. They took a pause for good reason, but the Fed has at least 2 more rate hikes. So to summarize it all up, it's like all of the givens, all of the facts that we know, everything of the situation that we know and should understand, are not pointing to. They may call it a bull market right now, and hands down, the market is going up. And those that have participated in the last couple of weeks, particularly in the Nasdaq and the S&P, have seen it go vertical. And as traders, Dan and I have been like, a lot of smiles. It's like, because positions are making good money. So again, I think what Dan and I both are saying is like, just stay aware. Just be aware of what's happening and be able to control your own trading. By all means, we want to be participants in something that's happening. The price action is dictating, but there's enough headline risk, et cetera, et cetera. And yes, go ahead, because I know we want to summarize on your side too.
Yeah, well, let me quickly address that 20 PE you mentioned, because I had that written down and kind of overlooked it. But yes, if this is a new bull market, then it's the first time in history that it ever would have started with a 20 forward-looking PE ratio. So if you're looking at forward earnings, multiple of 20 when this started, that would be the first time in history a new bull market has started with a 20 forward PE, just to throw that in there.
Right. I mean, it's a high bar, because in essence, I think folks, if you're listening to me often, I'll talk about it. It's like, wow, they're setting a pretty high bar if they're going with Ford and Guidance, and everybody's thinking that these big tech companies are going to continue to have these blow the doors off earnings. Well, that's a lot of pressure. That's a lot on not only the corporation, but on everybody else involved, plus us as a part of the economy, as the consumers, when we're talking about like Apple or other, where we have to buy these products. It's like, is that all going to be the same? Is that all just going to skunk everybody? And it's like, well, moving forward, it's a pretty high bar that you got to meet.
Right. And the high multiple means that even if we're not going to have a recession for some reason, let's say the recession argument is wrong, it's not going to be a recession. The market's high multiple, as it goes up and increases that multiple, is pricing perfection. The market is a price discounting mechanism. It's looking 6 to 9 to 12 months forward and discounting it now. So if the market, by going up this much, is saying, you know what, 6 to 12 months out there, this is what we're seeing, then it's pricing perfection, and there's pricing it, the multiple, way up here. By up here, I mean above 20 to wherever it's going to end up. And it's hard for the market to continue going up when it's got that high of a multiple already priced in, discounting already, no recession or whatever the narrative is. It's like you said, an awfully high bar
to try to maintain. I'm going to say thank you. It goes by so quickly. And if this gives any indication, it's like Dan and I talk often, and often we're like looking, oh, we've been talking for an hour and a half and still have so much more to say. And so with that in mind, I'm hoping that we will be able to do several more of what I'm terming behind the curtain, taking a look at behind what you're getting from financial media to hopefully help put everything into perspective as to what we are saying, or and from my side, what I'm saying almost on a daily basis about the structure that's happening. So again, thank you very much, Dan, for spending time with me today.
You're welcome, and thanks for having me again.
You're very welcome. And again, those that may have a question for Dan, go ahead and give us that email address.
Yeah, info@defendingyourmoney.com. I'll say that again in a second, but that site is still being built and it's still coming up. So when you see it, give it a little bit of slack because it's still being built.
Right.
But it works. Info@defendingyourmoney.com, or hit the contact menu selection. That'll go to a form, and then that'll come over to us if you want more information.
Right, because Dan wants to hear from you. He wants to hear your questions, and he will answer you. And for me, it's like on YouTube, you can leave me a comment. I will, if you have a question, I will answer it. If not, then you can also contact me or get a hold of me by michael@mjf1partners.com. And again, I welcome questions and we welcome comments. And again, thank you very much. And I look forward to the next one. And everybody else, have a great balance of the weekend. Remember, holiday on Monday. Thanks.
Have a good one. Bye-bye.
Bye.